So the stock market is looking exciting again, especially if you are a value investor like me. In the last 10 days, we have got the S&P 500 falling from its high in mid-February down over 5%. You've got the Nasdaq down over 8%, and then for individual names, I've got Nvidia down 26% from the highs, but Amazon down like 16%. So what's happening? Why is the market going down? Well, there are three main reasons. Number one, tariffs. Number two, Doge. Number three, seasonality. Now, the first reason is obviously Trump going ahead with tariffs on Canada and Mexico. He went ahead imposing 25% tariffs as of today, as well as doubling his tariffs from China. And what are these countries doing? Yeah, they're fighting back. So this is creating the trade war 2.0, now the Canada and Mexico and China version. If you recall, 1.0 was back in 2018 when the trade war was just with China alone. And what happened then? If you recall, it created a panic and the S&P 500 fell 20%, right? It didn't actually trigger a bear market, because bear market means that the market has to close below 20%. But in this case, the market just touched 20%, and then it flushed out, and the market went all the way back. Now, could this happen again? Could the market drop 20%? It is very, very possible now that you've got Canada and Mexico together in this trade war. So it's very possible market could go a lot lower if Trump really gets aggressive and they really fight back. Of course, in addition to the tariffs, the second thing that's causing what we call a growth scare in the markets, the market is now concerned that the economy is not going to grow anymore, is of course Doge. Now, of course, I think the intention of Doge is very good. Cut government waste, reduce the national debt. I think that's fantastic, obviously, in the long run. But of course, in the short term, it's going to cause some pain because a lot of people get retrenched from the government, right? So in fact, latest numbers show that in Washington, D.C., the unemployment claims have quadrupled in the last 1 month. Okay, so you've got the tariffs, you've got the Doge, and that is all showing up in the GDP numbers. So if you look at the Atlanta Fed, which tracks real-time GDP, you can see this news headline that came out a few days ago that now first quarter GDP for 2025 is negative for the first time in many, many quarters. In fact, if you take a look at the latest Atlanta Fed GDP now data, it's now projecting GDP for quarter one at minus 2.8%. It was positive 2.3% just a week ago. So this is a huge reversal, and you've got two negative quarters of GDP. That's a recession. So could we see a recession this year? It is very possible. Again, if Trump continues with the tariffs, gets more aggressive, and Doge continues firing a lot of federal workers, this can indeed happen. So what is actually causing the GDP data for quarter one to turn negative? Well, if you dig into the numbers, you can see that the main reason why GDP has turned first of all, negative 1.5% and now negative 2.8%. The main reason is you can see here change in net exports. So historically, it's been like minus 26, minus 29, minus 27, right? But suddenly, on the 20th of February, it's minus 248, and now it's minus 238. So why? What has caused this huge change in net exports? Well, it's because the imports into the US have jumped from 5 suddenly to 29.7 and 26. Now, remember that when you calculate GDP, imports reduce GDP. Exports increase GDP. So when imports are more than exports, GDP drops. So why the sudden surge in imports? Very simple. Think about it. If you are an importer and you think that Trump is going to impose 25% tariffs on the 4th of March, what would you do? That's right, you will import everything as much as you can before the tariffs come into effect, right? To avoid the tariffs. So you've got this sudden surge in imports before the tariffs go in force, and that creates this huge number there and then reduces GDP, tracking GDP for quarter one. Now, is it a guarantee that quarter one's GDP will indeed be negative? Of course, it is not a guarantee. This is a tracking data that is updated regularly, right? So of course, this could reverse, and by the time the actual GDP is released, it could be positive. Well, hopefully so. Now, of course, it doesn't help that seasonality shows that usually middle of February, the market tends to sell off. So if you take a look at this chart, you can see that this is the S&P 500 Seasonality Index that goes back over the last 20 years. And you can see that based on seasonal patterns, the S&P 500 indeed tends to peak in mid-February, sell off all the way to mid of March, all the way negative for the year before it takes off for the rest of the year. So why is Trump doing this? Now I've got 3 theories, and you tell me in the comment section which theory you believe, all right? So theory number 1 is that Trump is an idiot, okay? And he thinks that tariffs are something that the foreign government pays. But if you study economics, you know that when you impose a tariff, it is the importer that pays the tariff, that passes it on to the consumer, and that can cause a fall in demand for imported goods. That could cause a slowdown in the economy, it could cause inflation, it could cause a recession. All right. So the first theory is that Trump doesn't know this, he's an idiot, and he's creating a recession. Okay. Now my second theory is that Trump is actually a genius. And the reason Trump is doing this is because, remember, what was one of his intentions? He said a few weeks ago, together with his Treasury Secretary, that his main intention was to bring down interest rates, right? He especially wants to bring down the long-term 10-year Treasury bond rate for a few reasons. Number 1, when you bring down the 10-year bond rate, that means the government pays less interest on their Treasury bonds, so that reduces the national debt. Number 1. Number 2, mortgage rates and borrowing rates, they price off the 10-year Treasury yield. So when the 10-year Treasury yield goes down, mortgage rates go down, and the housing market will improve, right? As well as companies are able to borrow money better or more cheaply, and that improves the economy. So he could be a genius, and the reason he's doing this is because he knows that when you create a growth scare in the markets, people scared that the economy is slowing, they will buy treasury bonds as a safe haven, which is what they're doing, right? So people are buying treasury bonds. That's why you see the TLT ETF going up, and the treasury bond yield, as bond price goes up, yield goes down. So this is actually working. So the 10-year treasury yield has fallen from 4.55% at a high this year to 4.17%. So this could actually be part of Trump's plan. And of course, if this growth scare continues, then the Federal Reserve may be forced to cut the short-term Fed funds rate faster than they intended, which is what Trump wants to do anyway. And so by bringing rates down, that would improve the economy, at the same time bring down inflation. So in other words, Trump could be doing this because he wants to create short-term pain to get long-term gains, right? But of course, there's a danger that if he carries it too far, then it could trigger a really nasty recession. So it's a fine balance. So that's my second theory. He's a genius, right? The third theory is that he's an opportunistic bastard. Okay, that the reason he's doing this is to crash the stock market so that his friends and family can buy cheap. And then he reverses his policy, reverses the tariffs, market goes up, they make a killing, right? So which theory do you believe? You leave your comments in the section. Is he an idiot? Is he a genius? Is he an opportunistic bastard? Yeah. So what do I think? Honestly, I don't care. I don't care which theory works, because whatever reason, I benefit. Okay, so why do I benefit? Because as you guys know, as a value investor, I love it when markets drop in the short term, because it allows me to buy more shares of high quality companies. Now, when the stock of a company drops, there are two main reasons. First, it drops because of company specific reasons. Something's wrong with the company, right? And oftentimes you have to find out, okay, what's wrong with the company? Is it a short-term issue? Is it a long-term issue? Yeah. If it's a short-term issue, it's a great chance to buy shares when they're undervalued. If it's a longer-term structural issue, then of course you want to avoid buying the stock. But when the stock of a great company drops for reasons that are not company specific, that means there are macroeconomic geopolitical reasons like this, I love it. I love it, right? So as you guys know, I already own a lot of Nvidia. I own a lot of Microsoft. I own a lot of Meta. I own a lot of Nvidia. Did I say Nvidia already? Getting old. Amazon, whatever, right? But every year I want to buy more because I want to keep owning more and more of these great companies. But I haven't been able to buy a lot more because prices have not been very cheap. Some of them are already undervalued, but only slightly. So I want prices to go down a lot more, to be a lot more undervalued, so I can deploy more of my capital. So I always look at these short-term sell-offs, short-term drops as gifts for value investors, because in the long run, you know that these companies are going to keep growing in value. So any short-term drop is a gift to add more shares. Now again, they must be high-quality companies that have a historical track record of consistently growing revenue, net income, and cash flows from operations despite recessions, despite short-term trade wars. They must keep growing revenue and profits. Very important. They must have a durable competitive advantage, a strong economic moat that protects them from competition. They should have low debt. They should have high return on capital, return on equity, return on invested capital. These are the only companies I buy, because these companies, whenever they drop short-term, they are opportunities to add before they go higher. Yeah, but companies that have inconsistent profits, companies that have got weak economic moats, companies that have got low return on capital, companies that are over leveraged, I wouldn't touch them no matter how cheap they get, because they can drop and never come back. So just bear that in mind. Again, whatever it is, during these sell-offs, during these drops, as an investor, the last thing to do is don't panic. Remember, it is all part of the game. It's all part of the way markets work. And I always like to remind people that, remember that market downturns happen frequently, but they don't last forever. And on average, the S&P 500 will drop 5% or more at least 3 times a year on average. So far the S&P 500 is down just over 5%. And again, this is only once. It's going to happen 3 times this year on average. So be prepared for it and take advantage of it. And if you say, hey, Adam, I've got no more money to buy stocks, then just ignore it. Just hold what you have, close your eyes, watch Netflix. Because soon enough, the sell-off is going to be over and it's going to back to new highs again, right? And out of the 3 drops a year on average, once a year, the market will drop 10% or more. So could this be the 10% or more? Maybe, I don't know. We can never predict, right? And once every 3 years, the market will drop 15% or more. And once every 6 years on average, the market will drop more than 20%. And if it closes more than 20%, that's called a bear market. Now, I doubt we're going to go into a bear market this year unless Trumpy boy raises tariffs even more, they retaliate even more. Of course, everything is possible. We could get a recession, we could get a bear market. It is possible, right? But if I believe that Trumpy doesn't want a bear market, he doesn't want a recession, he's just creating some short-term pain to bring down the long-term interest rates, that at the end of the day, he wants the economy to do well, which I believe he does, then I don't think he will allow that recession or bear market to happen. That this could simply be just a pullback or a deep correction. And again, recall that during Trade War 1.0, back in 2018, the market did drop 20%. And so far, the market's only down 5%. So as an investor, you got to be psychologically prepared that we could drop a lot more. And that's why as an investor, whenever the market drops, even though prices are undervalued, I don't go all in. I always nibble. I always buy a bit first. I always buy in tranches. I buy over 3 to 4 tranches. Why? In case we get that 10, 15, 20% decline, I still have bullets to keep buying all the way down. And of course, I can never buy at the bottom. I can't predict the bottom. As long as I can do a dollar cost average and buy, somewhere near the bottom, is good enough, right? I've done my job for the year, and that's how my portfolio grows every single year. By the way, not all the sectors have been equally affected by this sell-off. So if you take a look at this heat map, you'll notice that the majority of the declines have actually come from the technology sector over here, which is my favorite sector, because over the long run, technology companies, they offer the highest growth rates, the highest profit margins, the strongest moats. And we are, again, within the early stages of an AI revolution. So any kind of drop in my AI-related stocks, to me, is a gift. It's a gift to add shares, right? The other area would be consumer discretionary stocks, like Amazon, And of course, you've got Tesla, which, as you know, for various reasons, I personally do not buy. All right. And then communication services like Google and Meta, that's down as well. So again, they are all related to the AI investment, which in a way is related to Trump. They call it the Trump trade, if you will. Yeah. But the other sectors actually have not gone down that much. In fact, some of them have been positive, like consumer defensives have been rallying. You've got financials have been rallying and healthcare has been rallying. And that's why it is so important to have a well-diversified portfolio. So for those of you who are my subscribers, you see my portfolio in real time. You know exactly what I'm buying and selling every day. I send you notifications. Every month I do a deep dive research in my portfolio, and I've got a lot of healthcare stocks. I've got consumer staple stocks. I've got financial stocks. So that goes up while my technology goes down. So it buffers my portfolio, and that creates a lot of resilience in the portfolio. So you got to always diversify. So finally, let's take a look at some potential opportunities. Now again, this is not a recommendation or advice for you to buy any of these things. That's my disclaimer, right? These are stocks that I own, and I'm happily buying more every year when I get them at good prices. So first, obviously, is Nvidia, which is one of my largest positions, and Nvidia is down 26% from the high, even though they posted very good earnings, and I think the demand for Nvidia is still very, very strong. Their Nvidia chips. So if you take a look, again, as you know, for me, I always look at the intrinsic value. As long as the price goes below the intrinsic value, I will want to add shares if it retraces to a technical support level. So in the case of Nvidia, my intrinsic value is $130, and these are the support levels I've identified based on historical support patterns. At 121, that's the first support level, which it broke below as of the last few days. It broke below that first support level. Then the next support level would be at 101, and then $90, and then $75. So these are my 4 buy levels, if you will. So every year, what I do is that I would allocate. I say, okay, for example, I want to buy 100 shares this year, and what I'll do is I'll buy 25 shares first at the first support level, and then if the price drops even more to the second support level, I buy the next 25 shares. So I keep adding more as it drops to these levels, so that I average in the position. So essentially, that is what I do for my stocks, right? So that's Nvidia. So Nvidia is currently undervalued and just below the first support level. Okay. Amazon is another one of my biggest positions, and I think one of the strongest, highest quality stocks in the market. And you can see a recent price action over here. So it's wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So big wave down, it tests the 50 moving average. Wave up, now it's waving down, looking to test that 50 moving average over here as well. So my intrinsic value for Amazon is 221, and the next support level is 195. You can see a pretty strong support at 195 over there. So that would be an interesting level to add. And of course, could it break lower? Everything is possible if we get a deep recession. Then my next support level will be 166 and then 151. Okay, let me show you a couple more. We've got Microsoft, for example. Microsoft also down from the highs, and my intrinsic value is like 415, and right now it's at this level of support. You can see a pretty strong support level over there, right? So in fact, I just added some Microsoft right at this support level. And again, could it bounce back from here if Trump suddenly U-turns on a policy and say, okay, I changed my mind? Sure, all right. But if it continues, could it break to the next support level at 364? Sure. If we go into, let's say, a recession, could it break all the way to 324, the last support? Of course, it's possible, right? So as an investor, always have all these pre-planned in mind. Finally, I think the other very high quality company that people are not giving enough credit for, especially with their Waymo cars leading the autonomous robo-taxi industry, as well as their YouTube doing really, really well, is of course Alphabet, Google. Google has sold off quite a bit, and Google's intrinsic value, in fact, it just increased based on the increase in free cash flow, is $223. That's the valuation, and right now it's very undervalued. And you can see all these are the support levels I've identified, and it's broken the recent support over there, and I'm looking to see if it's going to test the third support. This is another strong support where an investor could add at a pretty good discount. Right, so there we are. That's the state of the market right now. Hope this has been useful. So as an investor, remember, psychology is the most important thing. Happy shopping, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.